and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guest for today is Craig Jeffrey, Managing Partner and Strategic Treasurer. Welcome back to the Open Treasury podcast, Craig.
It's good to be back, Push. There's so much news going on across a number of topics. I'm excited to get started.
Absolutely. And today we're going to touch on global supply chain, crypto investments, expanding and contracting treasury developments, and finally, the pertinent topic around climate change and sustainability. You can find these articles in the show notes from this podcast or by looking them up on CTM File. Craig, I think the first section revolves around stories that I think will have a lot of corporate treasurers interested, particularly from the supply chain perspective, with China announcing the reopening of certain important locations. Also, the fact they're reopening after a 2-month lockdown. Although residents and international media has expressed confusion and skepticism about how far this reopening will go. So this is the first story. The second story, which is in connection with this, is the article which we've published on CTM File around the retreat of globalization. There has been an accelerated call for deglobalization amid concerns by corporates, particularly for organizations with complex multinational supply chains, primarily because of 3 factors, the pandemic being one, the Russia-Ukraine war, and the stringent lockdowns in the world's factory, China. So these have fueled calls for deglobalization and self-sufficiency. This article titled Deglobalization or Evolving Globalization on CTM File attempts to resolve the corporation's conundrum or dilemma and provide a way forward. Craig, in this article, we presented 4 distinct scenarios, and I'm going to ask you about that in a minute. The 4 scenarios that looks likely to emerge from this article or this conversation that big business leaders are talking about. The first scenario is around reshoring, nearshoring, or friendshoring. The second scenario is what a number of economists and other experts say, that the world may be heading towards 2 distinct geopolitical economic blocks. One that is driven by market-driven economies like the US, Europe, Japan, South Korea, North and South America, and the other which is driven by blocks comprising China, Russia, and their important trading partners. So that's the second scenario. The third scenario is we are going to be back to normal, which is the first story, that China's reopening and globalization will now focus around or refocus around China. And the fourth scenario is that globalization is not going to end, but it is going to evolve in a different form, which is diversifying, backed by Michael Wog, the economist and monetary advisor at the Federal Reserve Bank of Minneapolis. He presenting it as diversifying, which in essence is to retain the China manufacturing operation and also explore production in other countries or buy and hold more inventory. My question to you, Craig, is that given the news of China's reopening amid skepticism and one of the 4 supply chain scenarios emerging that I just mentioned a few minutes ago, which scenario do you think most global corporations are likely to adapt to avoid getting caught in a supply chain crisis all over again?
I don't know that all of those different options are mutually exclusive. You know, we went from a time not too long ago where just-in-time inventory was awesome. That's what we looked at, reduce your inventory, get everything delivered almost just as you need it, reducing capital tied up in the supply chain. And I think we know pretty clearly that that's not how people are operating today. That's created other risks that have been overweighted vis-a-vis the delays that we see in the delivery of goods and the impacts that financial crises and, shipping, pandemic, et cetera, those issues can cause. So I don't think we're going back to that extreme. So that eliminates a couple of the options. But I think we've probably all looked at some of those maps where you see all the ships are, waiting or circling around some of the ports in China. And if you don't look at those regularly, it looks like, wow, this is insane how many ships are out there. Well, it's also, there's a massive number of ships that move goods at all time. And so this 2-month slowdown at one of the major ports in China and the lockdown in those regions is having a pretty big fall-on event for other groups, other companies. And people are responding to that. You learn from those mistakes. So you mentioned different items like nearshoring or closer supply chains. I don't know of any organization that's not either biased towards that or moving towards that. There's nobody who's saying we want to do more farther away, but they're still looking at this balance of where can I get my goods, supplies, or raw materials and have multiple locations perhaps to source those. That's certainly going to be some of what takes place. There's a continued pull to do more nearshoring or friendshoring. I think one of the options you talked about was more the democratic states, nation states working together more fully. They've always had very good trade, but I don't think that's the end result. There's going to be two different worlds, two different spheres where there's only trade happening that way. There's quite a bit of trade occurring across those. Now, North Korea, no, maybe not so much. The isolation of Russia, not as much. China's trading with quite a few places, and others will pick up some of that slack as people continue to diversify. But I don't see that, shifting. I mean, maybe it pulls back a bit. We've seen some pullback, but I think we'll continue to see that growing. There is quite a bit of pressure on the two economic blocks. Right. There's pressure for that, for trading. We'll see what happens with China after Russia's become much more isolated. How will that impact other nation states who want this other trading block? It's kind of hard to trade apart from the Western nations. It's kind of hard to trade apart from China. I mean, there's a lot of interdependencies on the economy. So I don't think there's just going to be this massive rip and lift in a few years. These are supply chains that have been built up over decades. So that's a long way of saying none of these sounds like it's the be all and the end all. Yes, there'll be more closer supply chains. Yes, there'll probably be more trading, more favorability towards, democratic versus less free nation states. But I don't expect that to shift. The return to normal, that's the one I can say is it might return more closely to where things are, but will it return to normal? Like the way it was? I think we've seen shifts back in the financial crisis where it dipped. We did a lot more trading between you return to onshore, gets a little tight. It's like if you're really cold, blood returns to the center of your body to keep you warm. Your appendages, get chillier. We see that in these big dislocations. And you share a great chart that's in there from the World Bank, going from 34% of the global share of trade to GDP, to a peak in 2008 of 61%. When we had the financial crisis, we've had some other dips. Well, we're down to, in 2020, it shows down to a little over 51%. So down a little over 9% from the peak, but still up 17, 18% from where we were in 86. So things are more complex than we think. And this balance and diversification, to your points, diversification of the supply chain, having stuff closer is part of a risk management approach.
Very enlightening perspective, Greg. The next section is about crypto investments. Germany, Europe's largest economy that intends to facilitate easier crypto investments. So its Ministry of Finance announced last week that they will alter the strict tax laws into a more lenient one for crypto investors. Specifically, crypto holders will not be taxed on profits unless they sell within the year. On the contrary, the European Central Bank, or the ECB, commented on Tuesday that cryptocurrencies pose a risk to financial stability. ECB said that highly leveraged transactions offered by cryptocurrency exchanges have led investors to borrow funds to increase their exposure to cryptocurrencies, intensifying the financial stability risks. So as a corporate treasurer, Greg, do you find the German Ministry of Finance and ECB opinions as contradictory about crypto investments, or is it saying the same thing from a different perspective?
I'm not sure I'd answer it from a corporate treasurer perspective. As I look at this more from an economic perspective and a sense of business trade and caution from regulation, because I don't think there's massive amounts of crypto interest and activity now on the corporate side. So it's more of a interest in paying attention. But is it contradictory or is it just different nuances? I think that's a good point. Germany's position is pretty interesting. There's less taxes, less regulation, making it easier to do business, which is more free market oriented. Germany doesn't normally lead in that area. There's a number of other nation states that tend to do that. So this is quite interesting that they're making it easier to make crypto investments. On the tax laws, they won't tax profits unless they're sold within a year of acquiring them. So it's pushing them for longer term holdings, some stability there, reduction in what would be otherwise short term taxes. So I think that's a more open market view that they're taking. On the ECB side, one of the items in the article was the industry's lack of data is also said to hinder the assessment of financial risk. And the ECB is warning about crypto exchanges and data aggregators are publishing this data. It needs to be treated with caution. That is a superb warning. That needs to be in bold, highlighted. This lack of visibility, lack of transparency creates issues and concerns. And we've seen this movement of the value of these cryptocurrencies, massive movements. We saw basically a tenfold valuation increase from back from early 2020 to November of 2021. It was like a tenfold increase of 300 billion to 2.9 trillion. We've seen a pullback of about 60%, since some of the disruption and dislocation, but it's very volatile. We think about that kind of growth and pullback. That's not common for, equities. Even in the most volatile times, we don't see 60, we don't see tenfold increases across a basket of things. We don't see 60% pullbacks. So it's extraordinarily volatile for what we're thinking about. Even when you think about foreign currency rates, currency pair exchange, unless a country's in massive distress, you don't see this type of movement. This lack of data and transparency, I think, is, if that continues to be ironed out, that will show some positivity there. But their caution is well ordered at this point.
Caution, extremely important word. And this ties into our third section, which is at one level about expansion, at the other level, it's a contraction story. So expansion and contraction stories in the world of treasury and finance. On the acceleration of the expansion part, we have the news that Citigroup is considering a deal to buy Deutsche Bank's Mexican bank. We also have published the news about the recent partnership between Deutsche Bank and global fintech firm FinLink, which is set to facilitate real-time treasury adoption among corporations, enabling treasurers to reduce the IT burden and time spent connecting to Deutsche Bank APIs. On the contraction part, we have the US Federal Reserve that has signaled that it intends to delay the implementation of ISO 20022 message format for the FedWire fund service to sometime in the first quarter of 2025. Also, Ripple's chief executive has said that the possibility of an IPO can be explored only after the ongoing lawsuit brought by the US SEC against the XRP network ends. Is this story between the slowdown within the non-banking arena, which is corporates and solution providers at one end, and then you have the banking sector, which is expanding, or the fintech sector wanting to do, something different? So is this a clear-cut demarcation that corporates may be moving in one direction and the banking sector of the fintechs and financial institutions moving in more of an expansion mode?
That list of articles and events that are occurring, let me try to respond to that in pieces as opposed to the broader request. And I'll see if I can do that at the end. We've talked about Deutsche Bank and FinLink, this set of established API libraries, which makes it far easier to connect, particularly with the SAP environment, connecting deeply, faster to connect, easier to integrate. That is an acceleration item, and it's, a fintech and a bank. And we spoke about this a little earlier. This is an area where speed matters, simplicity matters, and that's creating a drive for better visibility, more efficiency, and across the board. So that's a significant positive development as we continue to see this, and banks partnering with fintechs to support their corporate partners. So we do expect to see that continue. You also mentioned the Fed pulling back on the timeline for ISO 20022, that format for Fed wires, pushing it back about a year and a half from their plans, from late or November of 2023 to the first quarter of 2025. That seems to be more of, we need to make sure we have enough time to test. And that's the traditional, hey, banks need to be very cautious. They're putting in tons of improvements in their systems. And they're like, we want a little more time. There's a lot going on. That's why fintechs do so well, because banks can be, very, very cautious on that front. You also mentioned Citi looking at Deutsche Bank, and I think that's really interesting. I mean, Citi has long been withdrawing on the retail front outside of the U.S. That's been stated, and they've been expanding on the corporate presence. So, Banamex, I don't know, it's been well over a couple decades. They acquired Banamex in Mexico, and so it looks like they're growing their corporate business. This is what they've been focused on for a long time. That's a continuation of an existing trend that they have.
May I ask you, you touched upon the fact that Citi is continuing with its global strategy of pulling out of consumer banking and focusing more on corporate investment banking. And then you have Deutsche Bank going ahead and, wanting to reduce the IT burden through the APIs. Are we seeing, within, say, the banking and finance sector, vis-a-vis even corporate treasury, are we going to be seeing more of these global banks trying to focus more on corporate banking, investment banking, foreign exchange services, as opposed to leaving some of these, the individual side of banking more to, more of the local players within their own countries, say public sector banks or organizations are not necessarily international banks, but more banks which are homegrown within their own countries?
Part of the response to that question is beyond what I can say or what I know. But here are some things that I would say just to provide some context for that. Even the trillion-dollar banks, even the multi-trillion-dollar banks have to focus on what they can do. There's so much. The economy is so huge. The globe is massive. And when you're pouring money into, consumer banking, small business banking, commercial banking, large corporate banking, investment banking, wealth management, you can start listing, custody, investment management. When you start listing all of these areas and the amount of investments that are required in light of the complexity of regulations, globalization, multi-currencies, everyone has to make decisions. Nobody's at the point where you can say we're going to do everything all at once as hard as we can. So there's the restrictions. If you have $250 billion and you're investing a certain number of millions of dollars in your portfolio and platforms, you can do a couple things. When you're, $1 trillion, you can invest in quite a bit more because you're spreading this investment over a larger pool of clients who are funding and generating revenue. But there is no bank that can fund everything. Every type of customer across every geography across the globe. So therefore decisions have to be made as far as where is your focus going to be? And does that leverage itself, in Citi's case, commercial and corporate, large multinationals across the globe, certainly a key area of focus there. You have to make decisions with limited resources.
Moving on to the last section in terms of our stories for today, which focuses on climate sustainability by fines. I found the story very interesting where the Bank of England stated on Tuesday that banks and insurers that cannot manage climate risks as a top priority issue may face 10 to 15% penalties against their annual profits and require higher capital adequacy requirements, I'm assuming. Do you think that climate risk will sustainably reduce the profitability of banks and insurers over time, particularly if they are not managed effectively? And do you think central banks around the world will not only start imposing financial penalties, but will mandate climate stress tests?
Yeah. So this one was a very interesting article. And, there's certainly some concerns. Many people are very concerned about the climate and want regulators and large banks to focus on that. Others, see it as something as a risk among others to be concerned, and others see things like ESG as being overly hyped or more politicized than normal, and requiring a different level. And so among this range of views and perspectives, having a climate stress test, I think there's certainly some reasons for how these are done, how these are factored in amongst all the financial risks that can take place. What's going to be important here as this development in the UK and perhaps in other jurisdictions happen is how political is this versus how economic based it is. And so there's some feedback there. I think it's going to be really interesting to see, is this really a true economic model, or is this geared towards we want an outcome based on our particular view of weather, climate, et cetera? Because whatever view you start with is going to influence the variables you use and how you factor these in. And so that's a touchy and important activity. So if you love it, you may say this is awesome. They'll make it an economic imperative to put it as one of the top items that they're managing. And how quickly is that done? How does that support the bank risk? And so some things like, what is the Bank of England talking about here? Well, it's higher capital requirements. So you have to reserve more funds to, if you have a greater risk to the climate or if you're not doing as much, as well as an additional tax. So you have to reserve more and you have to take a bigger haircut on your market, your margin. So these are not small things to do. And then one of the challenges that can have an impact on if someone goes too much, that can push capital to other countries or regions that may not be as out on one end of the spectrum. I think this is really worth noticing and worth following to see where this goes. This is no small issue.
And do you see other central banks doing the same?
The Bank of France did this as well. So there's some institutions. I'm not fully read up on all the banks that are talking about this. This has been a push by climate activists to push central regulatory bodies to make these requirements for banks because of the ripple-on effect of them providing loans and credit to other organizations, as opposed to making it just a legal framework, making a regulatory framework and pushing it down. So this is certainly part of the playbook to move that through.
Great. Finally, Craig, what is your choice for the biggest or most important story of the past week and why?
In terms of the news stories, versus the article, there was a position article you wrote, Push, on the deglobalization or evolving globalization. I think from a thinking about item, there's only one that we really reviewed. And so, thinking about this deglobalization, how is that changing how businesses operate and the impacts on finance? That was clearly the case there. But in terms of the other items that we're talking about, it seems that some of the activities, like Citi and Deutsche Bank may be, one of the top items that there's, major banks looking to make moves to focus on their core area as they say, where can we best play and do really well across the globe? That's pretty significant, in one regard. So pretty encouraged by, Shanghai opening up. I think that holds some short-term benefit, but these other macro shifts, I'm going to go with the Citi and Deutsche Bank, potential, even though it's only a potential. That's my number one pick. How about you, Push?
Initially I was going to be biased because of, like you said, the deglobalization story. There was so much of conversation around it, particularly in the World Economic Forum, Davos recently. So much of, conversation that's been happening offline, online around it. But, from a neutral perspective, I thought about the Citibank, and the Deutsche Bank story, and particularly when you articulated it right now, a few minutes ago, where you said that banks, this is in continuation with their strategy to focus on corporate investment bank. So I find that extremely interesting. But so there's the China angle in terms of reopening. So that's one C. The other is the Citigroup C. And then you have, currency risks, credit risks, counterparty risks, all 5 C's. And in continuum with the C's, I would possibly go with the climate sustainability and the climate stress test, and Bank of England actually wanting to impose 10 to 15% financial penalties. And you said capital adequacy requirements may change. Bank of France wanted to do that. I think that's a beginning, which if these banks in that part of the world have done, maybe some others have done, not that I'm sure of, I think it may be a very important, whether it's political or economic, as you mentioned. But they're all linked: politics, economics, corporate social responsibility. So I found that would be my story of the week.
That bears some additional talking over time. There was a bunch of ESG articles that have come out, some pushing that forward, some offering more ways to invest and support environmental or sustainability activity. And then there's some additional pushback in different areas. Are these really sustainable investments? So there's a whole range of what's going on as ESG, for example, continues its path forward. So that's probably a good topic for another podcast.
Absolutely. A big thank you to you, Craig, and to our CTM File audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.